Great. Good morning, everyone.
Should I introduce you?
No. Thanks for being here. My name is Glenn Stein. I'm a partner with our corporate group at Herrick Feinstein. I'm also the chair of our venture capital and emerging companies practices group. So today I want to talk briefly about money. We're all here to get our companies off the ground and raise capital. So today let's just go over some of the stages of capital formation for private companies. We do a lot of this work at Herrick, and hopefully this is interesting. So first we're just going to go over what is capital formation, and I want to touch on some pre-capital raise items, things you should consider in getting your company ready to raise money, some common funding structures, as well as we'll touch on the legal and regulatory environment and the regulatory, some recent developments in that area. So what's the end game here? This is sort of the big success story from last year. WhatsApp, probably all heard of that. Facebook bought this mobile messaging app for $19 billion. This is, talk about a successful exit. I mean, this is what we all dream about, right? One VC company invested in that, turned their $60 million stake into a $3 billion investment. So that is the gold standard, but they couldn't have gotten to this point if they hadn't raised capital from their founders, from VCs. So let's talk a bit about that. What is capital formation? So we're really talking about a method for increasing the capital owned or under the company's control. Raising money, right? It could be for product development. You want to build the better mousetrap. You want to develop your app or your website. You want to use the money for marketing, advertising. You got to get your word out no matter how good your product is. If you can't promote your product, you're not going to be a success, arguably. You have overhead, right? You need to keep the business going, rent, utilities, equipment, etc. And personnel costs. Sometimes people actually like to get paid for what they do, right? It's very strange. As founders, you're used to scraping by with nothing, right? So every now and then it's good to pull a dollar or two out and actually see some money. The landlord likes their rent check. So briefly, just some items, and Joel touched on some of these for pre-capital raising, things you should focus on. Obviously, you want to incorporate your business or form a separate legal entity, whether it's an LLC. Lewis touched on, LLC versus corporation. Protecting your IP. Hopefully, Barry Werbin will come by. You want to make clear that the IP is owned by the company and not a particular founder. Last thing you want, the foreign company in our case, right? But regardless, last thing you want is a year down the road, 2 years down the road, when your VC is diligencing you and you come to realize that the IP is all in the name of one of the founders, and now he could theoretically hold you hostage. You want to make sure the entity owns the IP or an affiliated entity. Work for hire agreements. You want your employees, particularly developers, people that are consultants, advisors to you, make sure that they're actually producing the work for the company, right, not themselves. Similarly, non-solicitation and non-competes. All these things should be part of kind of the startup toolkit when you're getting off the ground. Additionally, your governing documents. You want shareholders agreements among the principals, or a well-drafted LLC agreement that's going to deal with transfers of equity, management rights and control, etc. And typically, if you don't have these, in later rounds, a VC or sophisticated investor is going to require that you have them, and they're going to be instrumental in drafting them. So let's talk sort of common funding structures. You've got self-financing or bootstrapping. You're all familiar, I'm sure, with that. Maxing out your credit cards, friends and family, borrowing from your kids' college fund, everything in the world. We have equity. Preferred stock typically is the vehicle that VCs and investors want, and debt, which often now means convertible notes. You see a lot of in the VC space. So bootstrapping is sort of that first level of funding for a lot of startups, outside investments. Just at the beginning really isn't a realistic option. We heard some statistics earlier about how difficult it is to get VC financing. There was a recent Forbes article that said only 300 of the 600,000 businesses started last year in the US got VC funding. So only 300 of the 600,000 So it's a very small percentage. And even that is probably higher than some of the statistics we heard earlier. So with bootstrapping, you're spending your savings, you're reinvesting any profits if you're profitable at that point. You're borrowing from friends and family, maxing out your credit cards, et cetera. Some of the pros are that you've got full control of your company. You're not giving away equity to anyone. There's a limitless upside, right? It's all in your pocket. Some of the cons are that it's a hindrance to growth, right? Without that capital, you could only grow so much. You also might let some great opportunities go by because you're somewhat risk averse. Perhaps there's an acquisition that would get you to the next level, but you just can't afford it because you don't have the finances. So what's another way? So convertible notes is becoming very, very popular in the startup VC space. And a lot of times these are to friends and family and angel investors. These are initially a debt instrument, a promissory note that has the potential to convert to equity over time. Typically they'll earn interest of 6 or 8% per year, and they convert upon a qualified equity financing. Some additional capital raise of X number of dollars will automatically convert the debt into that type of equity that you're issuing. Typically there's a discount, so if you've gotten in on these notes, you're going to get more of that next level of equity. Often there's an optional conversion feature. And what's nice about these for startup companies is the documents more or less are standardized. There's a lot of forms you could find out there through Y Combinator or online. There are law firms that have libraries posted with VC startup type convertible notes. So you can get a lot of these out there, keep your legal costs down at first. Obviously, you want to sort of customize them. You want them reviewed. You want to make sure you're going out with documents that reflect the deal that you want. But it's a nice way to kind of get into that capital raising space without spending a ton of money. Let's talk for a minute or two about preferred stock, because this is the most common form of security issued to a venture capital firm. These typically give the holder economic and control rights that the common stockholder doesn't have. So it's a preferred level of equity. There might be dividends that the common stockholders are not getting. A liquidation preference, so if there's an exit event, if the company is sold, or if there's a sale event or merger, et cetera, there's a preferred return that goes out to these preferred holders, either 1 times or 2 times, whatever it is, their investment, plus accrued dividends. There are different types of dividends that can be issued. They can also convert to common, and this might be upon a qualified IPO or something. The equity would convert down to common, and typically preferred holders have anti-dilution protections. Also, often they have protective provisions, so you're really in a good spot as a preferred stockholder, where you might have a say on equity issuances or liquidation, sale of the company, sort of extraordinary events. You're going to have a seat at the table, so to speak, where the company can't do that without your consent. You might have board seats or preemptive rights, so you could always maintain your percentage interest in the company, information rights, registration rights, etc. So the following couple charts really just summarize kind of these funding stages. So beyond bootstrapping, early on you have what I'll call seed money, which is kind of the founders have their cash in the company, your friends and family, angel investors, where typically you've sold convertible notes, maybe between $50,000 and $1 million, and typically this is used for R&D and product development, all of the things you're used to. Determining your market, you might have a couple employees. Then maybe we move to a Series A round, where, again, we have our founders, friends and family. They might be coming in on the A round as well. Angels converting their notes, perhaps to this new level, the A financing. VC firms might be coming in. Again, similar purposes, scaling your product, maybe looking to grow geographically across markets, improving your business model. And then with each round, you sort of gain more sophisticated, generally more sophisticated investors, VC firms, private equity firms coming into a Series B. These later stages, we're typically talking about the larger institutional investors and a larger size of investment. At that point, you might be talking about acquisitions, and it just goes onward and upward. And we just sold a company that we represented from inception last year, and they had a Series F. They were up to Series F, and there was even a term sheet for Series G. So, you know, it can go on and on and on, and it makes the certificate of incorporation a disaster. It's quite a mess to deal with because each subsequent round is typically coming in with different rights and preferences, and they kind of stack on top of the prior round. So it makes it certainly interesting when you go down the line. I'd like to someday see how far down the alphabet we can get. F so far is the extent of my experience here. So what is venture capital? What is private equity? A lot of times they're used interchangeably. So really the way I look at it is with VCs, you're talking about more startup ventures, early stage investments. Really you're making a bet. And from what we heard earlier, a lot of times you're making a bet on the team, on the management team and experience, more than a product, a developed product or concept. So you have investors looking at your product concept or a prototype if you have, and you're typically investing in people, concepts. So I think as startup young companies, you want to present that. If you have a great management team that maybe has brought a few other businesses from inception to either IPO or to sale, exit, or just product to market, that should be your focus. Obviously, you don't have the numbers, whereas private equity are later stage investments, and you have investors really looking at established or more established businesses looking to come in and optimize performance. They might look at the company, they think maybe they can improve it, maybe they could do something better there, or they see potential and maybe a marriage, a way to grow this company. And typically that's where our PE investors are coming in.
Can I ask you a question?
Sure.
Where you put the home office or the family office area between the VCs and the private equity?
It really could be in both, right? It depends on what the sort of investment strategy is. How big is the family? What are the deals they're looking at? What is their investment strategy? Obviously, there are different rewards between where you come in, right? If you're arguably an early stage VC investor and you come in and it's the next WhatsApp, right? And you can have a great exit. That's a nice return, whereas maybe a PE shop would have come in at a much later round and at a much higher valuation and gotten less equity in turn. But that's a good question. It could be in either. Just briefly, let me touch on the legal and regulatory world here, because regardless of whether you're issuing debt, stock, if you're going out to the public to raise money, you've got to comply with federal and state securities laws. And these generally, we're talking about private placements to accredited investors. These are exempt offerings of stock under Reg D of the Securities Act. And I don't want to bore you with all of this, but basically there are three kinds of securities offerings under the Act. Registered offerings under Section 5, these are great, but they're detailed. There's a lengthy process to go through registering stock. There are enormous disclosure obligations. It's a great expense to a company. And generally, companies, certainly young startup companies, don't want to go that route because of the time and the expense involved. There are exempt offerings, which are great, fall under one of the exemptions. That's typically these private placements under Reg D. And there are illegal offerings. We counsel our clients not to go that last route, right? Avoid those.
We have clients who specialize in
Yeah.
What is a legal offering, for instance?
Well, if you're buying, you're just selling stock, and you're not within one of these allowable exceptions. You don't comply with the rules of Reg D. You're, we'll talk about it soon, but you're soliciting. And now there are some exceptions where you're allowed to solicit, but for a long time you couldn't generally solicit. You'd go on the airwaves, put radio ads, we're selling our stock, you know, please buy our stock. Or newspaper articles, subway articles, so things like that. Again, private placements, which generally are what we're talking about, are exempt from registration requirements of the Act under Reg D. It offers a safe harbor from the registration requirements, covered by a number of rules, but basically these are issuances to accredited investors. Accredited investors have a net worth in excess of $1 million, which excludes the value of their primary residence, or it could be individual income in each of the last 2 years of $200,000 or more, or joint of $300,000, or an entity in which all of the equity owners qualify as accredited investors. So as a private company, you can issue to a certain small number of non-accredited investors. There's an allowance for that. We recommend, and most attorneys would recommend, that you avoid that though. You want to issue your equity in a compliant offering to accredited investors only. There's a risk.
How many input accredited
I think it's
investors?
I think it's 16.
16.
I think 16 is the number. But you run a risk when issuing to non-accredited investors later on that they can rescind their investment, which would be a bad thing.
Can you elaborate?
Well, they can argue there was information material to their investment that they were not provided with. They were not sophisticated enough to understand what was disclosed to them. You're running the risk that they might make claims like this and withdraw their investment. You'll be forced to give back the investment, which is
So
not a good thing.
How did the company
How do you make sure? You need to use reasonable steps to verify that your investors are accredited. And there are some guidelines that the SEC has put out, having investors fill out a subscription document. If every public, private placement of securities, at least when we fill out and draft private placement memorandums, investors get a subscription booklet. They're answering an investor questionnaire, which goes through a checklist of items where they are certifying to you that they meet all of these standards. You can ask to see tax returns. There are reasonable, it's sort of loosely defined, right? Reasonable steps that you should take to verify for the company, for the issuer, to be kept in the clear, so to speak, that the investment is to an accredited investor.
The question, if you're a small company and
Yeah.
you're looking for money and you're coming, with those requirements to potential investors, if they will provide you with this information. But if you're Uber or if you're Facebook or if
I
you're
have not had a situation with a small company going out to raise money where folks have not filled out the information. And it's fairly standard here in the States that they would. I think
By the way, if the company is a US company and the
Yeah.
investors are foreigners, it's make any change or it's not complying to that? If you have a US entity and
Right.
the investors are, your friends and family are abroad, they are not US residents.
You may have an issue in the Israeli securities laws
Right.
as well. You have to be careful, because we've encountered situations
Yes,
where,
not to become public companies. So
no, where even under the, even if you're not a public company, we have encountered situations where the Israeli securities laws say you need to have what the Israelis say are accredited investors as well.
Mhm.
They have the same kind of mechanism, which can be even more onerous, that can be harder to meet, the test can be harder to meet than the US tests. But the answer is there are some loosening, there are different rules.
There
for
are, and
foreign offerings.
also it matters the type of entity that you have that's issuing the equity, right? Because you can't have foreign investors in if it's a limited liability company. No, that
Shouldn't matter,
shouldn't matter.
shouldn't matter.
What you often see is you'll have sort of parallel vehicles. You often see a vehicle for foreign investors sometimes. It's fact specific, it depends on the structure, it
Look,
depends on the deal.
Right, so in the more advanced cases, we often have a US vehicle for the US investors and a foreign vehicle for the non-US investors, because they have different goals that I alluded to before. And you're doing an offering of the foreign company abroad, and that has to meet the foreign rules, it's not the US. And you have an offering of the US, and you just meet those there. But if you're doing one, if you're a small operation, you have one company and you're offering it to everybody, then you have to fit under one of the exceptions for foreign offerings.
Right.
That has different sets of rules, but you still have to look at those rules.
Right. We see
When the
often,
company is a US company.
When the company's a US company.
yeah, often in the fund space where you have a fund that's investing in a certain strategy, we see where there's a parallel fund.
Yeah,
That's a separate
It's
issue.
more advanced.
Yeah, yeah.
that goes to, remember I said sometimes you have a customized solution, that's where we're getting
Yeah,
to the
this is not
advanced
off the shelf, and exactly,
Right.
this is when you want to speak to Lewis and the planners
Fund
here.
formation group, yeah.
Right, right. We touched on it earlier about solicitations, and I passed the slide, but for the past 80 years, companies could not solicit investments. There's we can go back.
I'm trying to go back.
As part of the Jobs Act, which, maybe back one more. Back.
Keep going
Oh, yeah,
back
that's
further.
it. That's it. One more, I'm sorry.
More forward?
Forward. There we
you
go. There we go. So as part of this Jumpstart Our Business Startups Act, now there is some solicitation allowed. Just so you know, general solicitation means publicly advertising the investment round using mass communication. Now, it's sort of,
Everything is okay?
well, not everything, but it gets sort of difficult now because of Facebook and Twitter and websites and, right? It's difficult. Almost everything now is put out there. So there are certain conditions that apply. So now solicitations generally are permissible. Again, if the sale is only to accredited investors, so in this case, you can't sell to non-accrediteds at all, no matter what the number. And again, the issuer has to take reasonable steps to verify. And so the SEC guidance talks about reviewing IRS forms stating income, the investor certifications regarding their income, bank statements. These are things that you can look to. Whether the investors want to provide you with that is another story, but if they want in the investment, they're going to have to do it, and I would require that as the issuer. Also, there's a Form D that has to be filed with the SEC within a certain time of the solicitation. Very briefly, because it's been in the news a lot lately, just crowdfunding. We hear a lot about crowdfunding, right? And this again was part of this Jobs Act, and it allows issuers to offer and sell securities through what's called crowdfunding, and they have funding vehicles online that companies can raise money through. Kickstarter is a popular one. And typically they raise very small amounts from a large number of investors, and they're not issuing equity. Often in exchange for your gift or donation, your investment, I'll call it that, for $10, $20 or whatever, you'll get a coupon for a free muffin or a movie ticket or macaroons, coffee. So these are all things that companies have given out. They're rewards basically for investing and being part of getting this venture off the ground.
So it's not actually.
You're not getting
part of the
equity.
Not
Right.
equity.
Correct.
Sometimes you get a discount on the product or something.
Yeah, or a free product,
Or free
exactly.
product.
So it's just an interesting concept. It's sort of in its infancy. It'll be fun to see how this develops. They have these online trading platforms that in the years to come are going to really grow. There are various proposed rules for crowdfunding that have not been enacted yet. The SEC is very, very slow to do anything. Some states have imposed their own rules. This is all very much in flux right now. So it's a way to raise money. People are financing films and television. You hear a lot about this. But right now, it's there's a lot of gray areas out there, and you have to be particularly in tune with what the state regulations are. I think some other countries have similar ways to raise capital. They've established their own rules, so we'll see where it all goes. Thank you. If anyone has questions, let me know.
Okay, so they're
Louis,
bringing
thank
in
you.
your pointer.